Welcome to session 6. We now enter the second half of the course on customer value management, which deals with questions related to pricing. You can imagine that in the first half, we talked about how much a customer is worth, how we should treat customers differently depending on their worth, and essentially the whole topic of the first 5 sessions was how to maximize the CLV of a customer. The topic of the remaining 4 sessions is how we can extract that CLV out of the customer. And if you remember the framework I showed you in session 1, the only way how we can actually extract money out of a customer is through means of pricing. So we will now cover various aspects of pricing within the next 4 sessions. I want to start today with a very quick introduction into the topic of pricing, then talk about different approaches that can be used to measure price sensitivity, and finally talk about the concept of economic value creation and how to estimate it. So let's dive right in. If you ask managers which type of decisions they think they're well informed on, it's interesting that they know relatively little about questions of pricing. Most managers, say 80%, so 4 out of 5 managers, are reasonably comfortable regarding cost information. They know the variable cost of their product, the fixed cost about their products. 75%, so 3 out of 4, know relatively well the prices of their competitors. About 2/3, 61%, know the product value, the value that their product creates. But then only 1/3 know anything about price response, which is the question how demand changes when we change price. Only 30% know about learning curve effects, and even only 1 in 5, about 20%, know anything about price acceptance. Price acceptance means what is the price that we can charge until customers still buy, or to put it differently, above which price customers would no longer buy. And this is really interesting because when you think about pricing, compared to any other type of marketing action that we have, pricing is the only action in marketing whose impact goes directly into the profit. If we increase prices by 1%, the increase in revenue of 1% is not associated with any cost change. So any increase in revenue is directly translated into an increase in profit. For example, look at the average economics of an average company. An average company, if they sell something for $100, usually has about 2/3 of variable cost, 66%, usually a quarter of fixed cost, 25%, and a profit margin of 9 to 10%. Of course, every company is different, but if you look at the average firm, these are about the numbers. Now, take 2 examples. Assume we improve price by 1%. Well, a price improvement of 1% means everything else being equal, we can now charge $101 compared to $100. Variable cost and fixed cost remain the same, because whether we sell the same product for 100 or 101, there's nothing else we need to do. So the $1 increase in revenue or in price directly adds to an increase in profit, which means we increase from 9.1 to 10.1, which is equal to an increase of 11%. If, on the other hand, we improve variable cost by 1%, which means we decrease it from 66.4 to 65.7, we only increase profit by 0.7, from 9.1 to 9.8, which is a 7.3% increase. And if you would have changed fixed cost, the impact would have been even lower. It would have been a change of 2.7%. And it's really important to keep this in mind because it means that price changes have the strongest impact on profit, which means we need to be very, very careful when we set prices. Assume you're managing a supermarket, for example. If you could increase prices in your supermarket by only 1%, you would increase your profit by 10%, or 11% in this case. And there's actually a question whether consumers would even realize that. Do you think you would see if your supermarket increased overnight every price by 1%? The change would probably be so minor that you wouldn't even realize it. When we talk about pricing, there are different perspectives that you can have regarding how prices should be set. One perspective that you know is called cost-driven pricing. And the idea of cost-driven pricing is that prices should cover your fixed and variable cost and allow to earn a fair rate of profit. The idea of cost-driven pricing is you determine the cost that your products have, and then you add a certain multiplier to it to determine the price. This is very consistent with what I showed you on the first slide, because managers feel very well informed about cost, and it's also very easy to do because you simply need to take cost information that usually you get from accounting and multiply it with some form of fixed multiplier. Customer-driven pricing is different because customer-driven pricing says prices should reflect what customers are willing to pay. If you are willing to pay $100 for the next model of the iPhone, I should sell this phone to you for exactly $99. I cannot sell it to you for 101 because that would be too expensive. And I probably shouldn't sell it to you for 100 because this means you would just be indifferent between buying and not buying. But I also shouldn't sell it to you for 90 because if I sold it to 90, this means I have left $9 on the table. And the third perspective is competition-driven pricing, which means that your prices should be somehow oriented depending on the prices of your competitor. Either you want to be cheaper than your competitors because you want to gain market share, or you want to say that you want to keep a price premium of your competitors because you do good marketing, you have a strong brand, you do something where people are willing to pay for. Looking at this, you need to first decide what type of value your product generates for the customer. Assume we are selling a phone, a restaurant, a flight ticket, and assume this product generates a value equivalent of $140 for the customer. In the last section of today, when we talk about economic value creation, we discuss one approach, how you can calculate this number, how you can come up with the 140. For the moment, just assume it's 140. If the product generates a value of 140 for the customer, this theoretically means you can charge any price between 0 and 140. You cannot charge more than 140 because otherwise you would charge more than the product is actually worth for the customer. But however, there are two constraints. The first constraint are your cost, the variable cost and the fixed cost. If you have variable cost of 30 and another fixed cost of 30, so a total cost base of 60, you probably shouldn't sell the product less than 60. And the second constraint is your competition. If your competitors sell exactly the same or a very similar product for 110, you might have a hard time charging a price higher than 110. So costs determine a lower threshold on prices, and competition tends to determine an upper threshold on prices. But this still leaves us a relatively large interval in our example between 60 and 110 of prices that we could charge. And exactly which price we pick within this interval is determined by a couple of different factors. These can be strategic constraints. Some companies want to be perceived as low price. Think of hard discounters, for example. So they would rather be on the lower end of the spectrum. Other companies want to be perceived as luxurious. Think of Louis Vuitton or Hermes. They would rather want to be on the higher end of the spectrum. And there are also legal and ethical constraints. If you are selling a vaccine that everyone wants, if you are selling an HIV medication that people need in order not to die, then probably you should be reluctant to sell it at a price that is so expensive that many people cannot afford it. In this sense, you can see the three different perspectives that I mentioned on the previous slide to be integrated in one general strategy of pricing. Competition-driven pricing tells you the upper limit, cost-driven pricing tells you the lower limit, and customer-driven pricing combined with legal, ethical, and strategic constraints helps you to decide within the range of feasible prices which price you should pick. There are multiple questions associated with each of these dimensions that we will discuss in one way or the other in the context of the next sessions. For cost-driven pricing, there is the question of break-even. What price do we need to charge in order to cover our fixed and variable cost? And there is also the question of sensitivity. How much do sales and profit change when we cut prices? For customer-driven pricing, there is the question of willingness to pay. How much are our customers willing to pay? And how can we segment the market based on willingness to pay? And for competition-driven pricing, there is the question of our value proposition, of segmentation, and how we differentiate ourselves from our competitors in order to ensure that we can charge premium prices. We will cover all of these points in one way or the other in the next 4 sessions. And we start by talking about one issue in the domain of customer-driven pricing, namely, how can we measure price sensitivity or willingness to pay?